Good afternoon. I'm Geoff Goodell, and I'm going to speak with you today about a paper that I wrote along with my colleagues Hazem Al-Nakib and Paulo Tasca called Digital Currency and Economic Crises, Helping States Respond. To begin, here's an agenda. I will first speak about some background on modern retail payments, including cash and card infrastructure. I will move into myth-busting some common misconceptions about central bank digital currency. And then I will deliver our proposal for a user-centric central bank digital currency based upon digital value containers. I'll describe how we can implement incentives to users to spend or save these tokens. And I will also explain how we can achieve privacy and owner custodianship in a way that can comply with regulations. So, one major question that people ask today is how to pay. We have a preponderance of different kinds of payment mechanisms that we can use every day for ordinary retail purchases, ranging from cash to cards to payment networks of various sorts to cryptocurrency and beyond. Now, when we consider our options in modern retail payments, if we look carefully, we'll see that there are some stark differences between cash and the various digital payments options that exist today. Cash consists of a direct private interaction between transacting parties, whereas in modern retail banking in the digital sense, the interaction is actually between regulated institutions. Cash is held by the owners of the money directly, whereas with retail banking, the currency is actually held by the institutions. And this aspect of owner custodianship is a very important distinction, because when we hold something, we are in control, whereas if it's held by institutions, that is not necessarily the case. Cash involves fungible tokens where everyone knows that a transaction will succeed without having to worry about whether payments infrastructure is functional, or whether counterparties will allow our transaction to succeed, whereas in the case of digital banking, the transactions can be intermediated or blocked by third parties, and in particular custodians who know our identity. With cash, we also know that everyone's money is as good as everyone else's, whereas with modern retail banking, different users might be subject to discrimination and profiling. Finally, with cash, we also have an unlimited choice of different forms of currency that we can use, as long as the counterparties are willing to accept the cash as valuable. It can be used for a payment, whereas in the context of retail banking that's intermediated by third parties, that is actually not the case. In particular, it can be limited by regulations. Now, the cashless society is something that we often hear about. It's widely seen as inevitable, a sign of progress. Often people will assume that because a payment mechanism that's digital involves more sophisticated technology, that it must represent progress and something that's good. It's often touted as a way to reduce tax evasion and crime, and we know that certain parties have used it for this purpose. For example, Narendra Modi in India had famously, a few years ago, stopped the circulation of the largest banknote in India. And Ken Rogoff of Harvard has written quite extensively on the potential benefits of having a currency that everyone uses that can be completely traced. But of course, this comes at the cost of privacy. And this is nothing new. 45 years ago, a gentleman named Paul Armour famously declared, if you wanted to build an unobtrusive system for surveillance, you couldn't do much better than an electronic funds transfer system. And this is very interesting, because this statement was made during an age when credit cards existed, but they had not achieved nearly the degree of popularity that they have today. Central banks are, of course, concerned about the decline in cash for various reasons. One reason is that they're keen to preserve a public payment option. And this is partly because they want to preserve financial inclusion and public utility using their money. But it's also partly to retain control versus bank deposits, cryptocurrencies, including corporate stablecoins and so on, that might present a challenge for central banks in implementing a monetary policy that works. Now, we know that in much of the world today, accepting cash has become optional. And there are some examples from here in the UK. Here is an example of a pub that is asserting not only that it doesn't take cash, but also that it's the first cashless pub, which suggests that there will be many more. And this goes into this notion of technological determinism. Also, we know that this isn't just about the coronavirus either. Going back to this goes back several years. Looking at this example from January 2018. This shop declared that it did not accept cash because of counterfeit notes and also because of the cost of deposits and various operations that are involved in facilitating cash management in a small business. This can actually be very important. For example, consider the cost of armored cars and tills and the time that it takes to pay someone to travel to a bank and so on. And of course, this also is reflected with this condescending note that we will only be accepting card payments because it is the digital age. If you have cash, your money isn't welcome here. And this is interesting. It's raised some questions about whether in particular there are some people who can be excluded by these policies, and whether a merchant might actually want to exclude certain patrons from patronizing their shop. Of course, we're not the only people who are asking the question, what do we lose when we lose cash? Of course, we know that there is an initiative here in the UK called open banking, and part of the objective of open banking is to facilitate disintermediated transactions in a retail context. However, if we look at the figures, we see that cash has actually declined, and cash is a disintermediated means of payment, whereas debit cards have actually increased to offset the rise of cash. And these direct payments, such as direct debit and BACS, have actually not increased in popularity that much. So we're asking, who benefits from this? Certainly not everyone. There is a program in Australia called a cashless welfare card, and this card is essentially used to restrict the kinds of purchases that its recipients can make. And certain groups in Australia have come to ask whether its use actually indicates that the Australian government and society do not trust poorer citizens with cash. So this gives you a sense of the power of cash, and this is something that we need to understand and consider very carefully. Now, one of the aspects of cash that is really important is that people can make transactions privately. And with modern retail payments in this digital sense, these transactions are not actually so private, and in fact, the institutions and the custodians can actually see how I'm spending my money as a user. And the recipients can see also, potentially, or the recipients' institutions can see where the money came from. And in effect, this means that institutional accounts and transfers between institutions can be monitored by a variety of observers. And this, of course, includes regulators, which might be okay, possibly, but it also includes credit bureaus, lenders, insurers, and other data consumers. And it also includes other government authorities, as we know from various reports that we've seen, which might suggest that even if we were to trust regulators not to have incentives to snoop, parties who do have incentives to snoop might have reason to ask them for their records. And we also see that the possibility of looking at these records and seeing them in one place means that there could be unscrupulous insiders, they could be exposed to hackers and other malicious parties. This is a very serious issue with digital payments, just as Paul Armour had said. So this raises the question of whether payments might be a form of a modern panopticon. And of course, Jeremy Bentham was specifically relevant to the founding and the early days of UCL. However, we see that if we look at people's payments, they actually paint a very powerful picture of what the user's financial circumstances and travel and relationships and changes in their behavior patterns might be. And this can also be very interesting to parties who want to exploit this, whether public or private. So Paul Armour again in 1967, so 53 years ago, he made a very interesting statement. The cashless and checkless society is obviously technologically feasible now and will soon be economically feasible. Spring water. What can you do if you have a craving for beer and pizza but do not want your credit score to drop? Today you pull out cash, and tomorrow? Would a privately owned payment system push you to the broccoli aisle? Would central banks jump to the rescue and offer a fully anonymous digital currency? Certainly not. Doing so would be a bonanza for criminals. Now, I think this statement presupposes certain things about how payments work, and we're going to explore exactly why this might be somewhat misleading. And we're going to show you today how it is possible to build a system that allows regulatory touchpoints without allowing mass surveillance. But first we have to look at cryptocurrencies and the motivation for cryptocurrencies. So many people think that cryptocurrencies started with Bitcoin in 2009, but actually they go back much further than this. Back at least as far as 1982, when a researcher named David Chaum published a paper, Blind Signatures for Untraceable Payments. Later, David Chaum started a firm called DigiCash, which was intending to provide an accountless system for cash transfers. And various other businesses followed suit, such as eGold and Liberty Reserve and others. All of these firms were shut down, ostensibly because, in many cases, authorities associated these groups with criminal activity, or more specifically, when they asked information about payments, they were not given any answers, precisely because the operator of the system didn't know the answers. So the use of distributed ledgers was in part important because it would prevent, potentially, these kinds of shutdowns. Now, the financial crisis that started in the middle of the middle of the aughts offered an alternative explanation for cryptocurrencies. This idea that you can hoard them and protect yourself from central banks, but we're going to argue that this is really unlikely as a motivation. Consider the success of stablecoins, cryptocurrencies that are actually pegged to fiat currencies. Really, we're going to argue that cryptocurrencies are mostly about privacy and trust of the system. And there's a reason why these various privacy-oriented cryptocurrencies have experienced the success and attention that they have in the years that followed, such as Monero and Zcash and others. So if we look at the various payment methods that are available today, we see that cash offers some really useful features. It's usable without registration, your counterparties can be anonymous, and it's fundamentally, potentially, private by design. Retail banking, of course, doesn't have all of those features, but it does provide the ability for tax monitoring and potentially some blocking of illicit owners or uses, and therefore it's different. But do we lose something when we move from cash to modern retail banking? We're going to argue that the answer is yes, and cryptocurrency is a way of bringing some of the features of cash, as you can see here, into the digital world. So, how do we bridge the divide between policymakers and the cyber libertarians who want privacy and the ability to conduct transactions on their own terms? Now, there are two possible routes for this, the first of which is have institutions support and accept cryptocurrency, and certainly we know that this is not impossible to imagine. We know that many large investment banks have created cryptocurrency trading desks. We know that PayPal now allows people to hold cryptocurrency in their accounts. But we're going to focus today on the second option, which I'm going to describe as trustworthy retail central bank digital currency. And in this approach, basically, we're going to show how an institutionally built solution can actually allow us to manage the risks that authorities have legitimately and want to mitigate, while preserving the control and privacy for the users of the currency, as is done with cash. So we're going to show how we can do this with co-regulation, how we can use distributed ledgers to ensure transparency for the system operators to make sure that the system behaves as advertised, and we're going to implement privacy by design, not privacy by promise, which means that we don't involve third-party trust. We actually have verifiable privacy at the edge. And most importantly, we will allow users to have the ability to hold value outside of custodial accounts. So, before we begin, we're going to create we're going to do some myth busting. And this will proceed with in the form of a dialectic. First, we're going to address some questions about account-based versus token-based designs, a wholesale versus retail orientation, questions about trusting the currency versus trusting the operation, and finally, questions about the use of modern cryptographic techniques which are designed to facilitate privacy. First, the question about account-based versus token-based solutions. So many of the digital currencies that have been described in papers over the past few years have involved account-based solutions. And many researchers have assumed that account-based solutions are better because they fundamentally allow for remuneration in the form of interest, and in particular that they allow rehypothecation, which is to say that they can be lent. But this argument makes some assumptions. First, that it is not possible to remunerate tokenized assets directly. But we're going to describe that there is a plausible mechanism for doing this. And second, that the purpose of CBDC is primarily to solve a problem of efficiency and nothing more. However, we believe that the decline of cash is a really interesting and important phenomenon that's taking place today. And CBDC presents an opportunity to allow retail users to continue to enjoy the benefits of accountless money in the digital age. So we conclude that we must allow value to exist outside accounts that can be used as money, so a token-based CBDC is more appropriate than an account-based one. And if you look at this slide which shows the taxonomy of digital money systems, there are the world of digital money systems can broadly be drawn into account-based versus token-based solutions, and token-based solutions can be divided further into centralized versus distributed ledgers. Now, it is entirely possible for a centralized ledger to facilitate privacy and control, but we'll also show why a distributed ledger might be more appropriate for this purpose. The second myth that we want to address is the question, can't we think of a CBDC as a kind of wholesale payments infrastructure for everyone? And this is basically driven by this question of whether much of the CBDC research that has been done in the wholesale context might be extended to apply to retail contexts as well. But unfortunately, there are some dangerous assumptions here also. One is that scalability is really the obstacle to more efficient payments. But think about how the various different financial markets participants actually achieve netting and risk management within the clearing networks that they've formed. Think about the questions of settlement in particular, and the tension between having faster settlements and having less opportunity for this netting and risk management on the part of the system operators. Second, the question of whether the requirements of retail and wholesale users of money are actually the same. They're not. Consider the human needs for privacy and the human need for owner custodianship. And finally, consider that a CBDC, many of the purported uses for CBDC is to facilitate cross-border payments. And we know that correspondent banking is very inefficient and expensive. However, we're going to argue that the problem of solving domestic retail payments is challenging enough and offers enough of a benefit that authorities and institutions alike should consider this as something that should be solved on its own terms. So that's why we're proposing a retail payment solution that is fit for purpose. The third myth that we want to address is this question of everyone trusts the central bank to handle monetary policy, so why shouldn't they trust them to handle their transactions? Well, as it turns out, it's possible to trust an entity in one context but not another, and overseeing a system is not the same as operating one. And just because a central bank has no apparent delivering monetary policy and perhaps issuing currency, but it's not about handling transactions. And that is why we've proposed a solution that allows other parties to manage transactions. Now, the benefits of DLT in this are not necessarily about privacy, but they're about really allowing the system to be monitored and for the users of the system to know that it's behaving as advertised. And there are liabilities and risks of running a system that we think are probably better not done by a government authority. And today, it's done by the private sector in the private sector clearing networks. Now, we think that there are benefits in the form of accountability and financial inclusion of having this be done by the private sector rather than the public sector, which is why we're facilitating this, to preserve the two-tiered banking system rather than to destroy it in the interests of something that might have dubious benefit. The fourth myth: isn't modern privacy-preserving cryptography not ready yet? Is it too complicated? Zero-knowledge proofs, stealth addresses, these are complicated methods. And the idea that this is something that we can't support really rests on assumptions as well. First, that cryptographic techniques are not well established, which isn't true. There are standards that describe how they can be used. And this idea that a government authority would actually need to implement a sophisticated technology on its own, and that's also not the case. Consider the case of co-regulation. And the example that I like to give involves the U.S. national market system for equity markets, wherein the technology needed to route orders from one exchange to another, and the infrastructure to manage the broadcast of the national best bids and offers are actually implemented to satisfy compliance objectives as overseen by the U.S. Securities and Exchange Commission, even though the U.S. SEC did not actually implement or design those technologies directly. So we conclude from this that we need a system that actually delivers true privacy, that we can build this, both by design and by default, in a way that does not rely upon third-party trust and also does not rely upon forcing government requisitions for sophisticated technology. So our proposal is to provide a government-issued electronic token that allows clearing and settlement by independent private actors and protects users from profiling. Here we introduce the concept of a digital value container, and we elaborate how we use this term. There are two categories of digital value containers most broadly. The first category is private DVC, which we imagine would be used for securities and other privately issued tokens. And the other category is government-issued DVC, or digital value containers that had been issued by a government. Government-issued DVC can be divided further into two categories: central bank digital currency, which has been most of our focus, which is representing obligations of a central bank, and fiscal DVC, which represent obligations of a national treasury. Digital currency can be labeled with vintages to indicate the period in which they're issued, and they can be exchanged when a new vintage becomes available. So the issuance of digital currency within a particular vintage means that it's fungible within that set. And if you imagine that vintages might be issued over a period of time, say 6 months or a year, the token might be accepted for, say, several years, but eventually it will expire. And before the expiry, it can be penalized or rewarded to encourage people not to hold or to hold the currency for a long period of time. So this can be used both to prevent hoarding and also to encourage saving if that's what's desired. And this is all done in a way that is outside of accounts and therefore preserves the privacy of its holders. So if we consider the typical user engagement lifecycle of a digital currency, in this case, we have an individual who might have received money into her bank account when she was paid by her employer, and then she goes to her bank and she asks for a withdrawal. Much as she would ask for a cash withdrawal from an ATM or a bank teller, she can ask for a digital currency withdrawal into her private wallet. And then, when it's in the transfer between her bank and the private wallet is shielded, just as it might be shielded with Zcash or Monero, such that the transaction landing in her private wallet is not linkable to the money that she received from the bank. So the bank knows that she withdrew the money, but doesn't know how she's going to spend it. Later, when she wants to purchase something from a vendor, she connects her private wallet to the vendor's technology to allow the vendor to receive the money into its bank account. So its financial institution knows that it received the money, but it doesn't know where it came from. So we've effectively decoupled the withdrawals from the deposits, just as we do with cash. And this is really important because this is how we prevent the individual from being profiled. We know that she received money. We know that she withdrew it. We know that someone paid for some product, but we can't connect the two. And that's essential for making sure that individuals are not profiled, which is an essential human right. Also, we can use this technology to mediate remittances between retail users as well. So if I want to transfer money from one individual to another, because the system is run by these financial institutions, they cannot just give each other the money directly. If they wanted to give each other their private wallets, there would always be a risk that they had copied the contents of the private wallet, and there's no way to prevent such copying from taking place. So therefore, we imagine that these money services businesses would be necessary in order to transfer the money from one individual to another in a way that the recipient knows that the individual had actually transferred the money and that it wasn't the same as a promise that might be broken. This might be done for a fee, or this might be done in exchange for a bank deposit or a time period during which the money services business can rehypothecate the money. Similarly, we can deposit central bank digital currency into a bank account. So once I've received money into a private wallet, I can put it into my bank account. Now, the bank might ask me information about the origin of the money, just as it does today if I deposit cash, but ultimately, the system itself does not reveal such information. And finally, we can use central bank digital currency to facilitate institutional disbursement to retail users as well. So this means that we can actually disperse money to people without requiring them to have registered bank accounts. The individual can go to a money services business, which might be a bank, but it might be a post office or another operator of the system that's registered and regulated, and can perform an identity verification check, and then that money services business can furnish the money to the individual into a private wallet rather than into an account. So if we compare to summarize, if we compare our system to both cash and modern retail banking, we can see that we have many of the best features of both. It operates electronically, so it's like retail banking in that respect, but it has the ability to be used without registration, and to facilitate anonymous counterparties, and to be private by design, like cash. And at the same time, it's also possible to monitor the receipt of funds for tax purposes in our system, and it's also possible to block illicit uses because we're blocking transfers to parties who might be problematic or questionable. Because regulators are involved in every transaction, we can also identify patterns through analytics. Now, of course, we would need this to, for this to stay private, we would need certain maintenance requirements. We would need there to be an open process for admitting new participants into the system, continuous security auditing, a funded commitment, and a diversity of implementations. This is much like what we have today for the maintenance of cryptographic systems such as SSL and X509 and related technologies. So to summarize, our solution relative to other CBDC proposals, we allow transactions to be held outside accounts. We do not need every individual to have a central bank account. This is actually a purpose-built domestic new real-time operational functions to be run by central authorities. So we can compare this to prevailing CBDC proposals. Here is a brief summary, which you can find in our paper. And here are some papers that we've written on the topic that can be of interest to you. Thank you for your time.
Thank you very much, Geoff. We have one question from the audience, from Joubert. The question is, how important is interoperability to CBDCs, and has it achieved a solution yet?
Yeah, well, I mean, I think it's a work in progress, so I'm not sure that we could ever argue that there is ever a complete solution. Certainly, there is an interoperability study group inside some of the various standards activities, including ISO, for distributed ledger technologies, which might be part of this. But the important aspect of our proposal in this respect is that we're not reliant upon interoperability in order across national systems in order for this to be effective. So since this is a domestic retail system, inside one particular country, we can decide to implement it a certain way, and we don't necessarily need to have universal agreement about how it should be implemented in order to achieve success. So while interoperability might make it better, for example, you could use your own wallet technology in one and another at the same time. That might be really useful. We don't need interoperability across national systems using this proposal in order for it to achieve substantial benefits. And we see this as really essential because we're never going to build the Tower of Babel and expect the whole world to agree upon a single standard for this, especially when regulators have different interests in mind. But at the same time, yes, we could potentially benefit from standardization, and certainly we're involved in those efforts as well. I hope that answers your question.
Thanks, Geoff, for the answer. I see that the audience is quite excited about this topic, and we have a lot of questions. But because of the time, I will just take one more question. I'm sorry about that, but I'll guarantee you that I'll pass the questions to Geoff. So one more question from Anya. What do you think, Geoff, retail bankers or payment providers have to do technically such that they can distribute a CBDC among end consumers?
So this is a very good question. So basically, we need consumers to have a mechanism for receiving money into their private wallets. So this is actually a research proposal that my group is considering, along with the University of Edinburgh, to explore what the design of this system in terms of devices might be. So if we imagine carrying around cash in a device the way that we carry it around in a wallet, we need this to have certain properties. We can't rely upon the idea that we're going to just call up our bank and say, no, that flat screen television was not something that I just purchased, because once it's gone, just the way it is for cash. So that means that the security requirements for these devices will be different than the security requirements for mobile banking, for example. So if that's the case, then we need to understand what kinds of devices would be involved. And I would imagine that there would be a user device to actually hold money in a wallet. Now, maybe this could be implemented as software, but I assume that we'd also want the ability to have hardware implementations as well, just as we do for cryptocurrency wallets. And similarly, we need devices for the point of sale, for merchants to be able to receive payments via this mechanism, as well as the touch points for facilitating withdrawals from banks. So just as we use ATMs and cards as an interface for withdrawing cash, we would need a corresponding interface for withdrawing CBDC. And this is something that is an interesting research topic, and we hope that we'll be able to help explore this area. I hope that answers your question.